This is the Simplify DBI CTA Managed Futures Index ETF, ticker symbol SDMF. In this video, we'll discuss why invest in SDMF, how the index works, and portfolio implementation. SDMF is a Managed Futures Index ETF. It seeks to replicate the DBI CTA Managed Futures Index. SDMF is the only managed futures index fund that replicates a diversified exposure to the largest managed futures hedge funds. Managed futures funds have some important benefits: diversification and support during risk-off market events. SDMF's specific benefits include index-based exposure to minimize manager selection risk, potential tax benefits, and a modest 0.35% gross expense ratio. Let's discuss these benefits in more detail. Managed futures have historically been a powerful diversifier. With a historical zero correlation with both stocks and bonds, managed futures may be a great diversifying asset that can be added to a stock and bond portfolio. Another potential benefit of managed futures is their historical support during risk-off market events. During the dot-com bust, global financial crisis, and 2022's inflationary bear market, stocks were down 47%, 55%, and 24% respectively, while the managed futures index was up 29%, 19%, and 28%. There have been few investments that have done as well as managed futures when it comes to supporting portfolios during risk-off events. An important benefit of SDMF is minimizing manager selection risk. There is an incredibly wide dispersion of returns in the managed futures space. Managers are all selecting from different markets, contract lengths, trading algorithms, rebalancing schedules, and target volatilities. An allocator can be invested in managed futures during a good year for the category, only to have poor results due to choosing the wrong manager. SDMF seeks to reduce this risk by seeking to replicate the returns of an entire group of managed futures hedge funds. SDMF also has some potential tax benefits. Index exposure is via swaps. Swaps are a derivative instrument that is tied to the returns of an underlying asset, in this case, the DBI CTA Managed Futures Index. Due to the long-term nature of the swaps, gains on swap transactions may be classified as long-term capital gains. Lastly, SDMF has a 0.35% stated gross expense ratio. This modest stated gross expense ratio makes it easier for allocators to include SDMF in model portfolios while keeping headline expenses reasonable. Now let's discuss how the index works. The DBI CTA Managed Futures Index seeks to replicate the returns of the largest managed futures hedge funds prior to deducting their fees and expenses. The index begins with the returns of the largest managed futures hedge funds net of fees. It then adds back an estimate of their fees and expenses, which are considerable. This combination is the replication target that the index seeks to track. In other words, the DBI CTA Managed Futures Index seeks to outperform the net returns of the largest managed futures hedge funds. The investable universe is futures contracts across 10 markets. Stocks, including the S&P 500 Index, the MSCI EAFE Index, and the MSCI Emerging Markets Index. Interest rates, including the 2-year U.S. Treasury, 10-year U.S. Treasury, and 30-year U.S. Treasury. Currencies, including the euro and the yen. And commodities, including oil and gold. The index takes the targeted return and then uses a sophisticated statistical algorithm to derive the weightings of the 10 underlying markets, long or short, that would have produced that target return. The model positions are updated weekly. Now let's discuss portfolio implementation. The first important question is, how much of a portfolio should be allocated to managed futures? At a minimum, allocators can consider a 5% position. Much less than that, and there really wouldn't be a meaningful difference in outcome. On the other end of the spectrum, investors that want to maximize risk-adjusted return can go as high as 20 to 25%. For those investors, typically investment professionals, who are trying to improve portfolio outcomes while also managing tracking error, a 5 to 15% allocation is a reasonable place to start. The next question is, how to source an allocation to SDMF. Assuming the investor starts with a 60-40 portfolio with a desired 10% allocation to SDMF, those seeking to improve their risk-adjusted returns might go with 55% stocks, 35% bonds, and 10% SDMF. For investors that want to improve both risk-adjusted and absolute returns, they might choose to source only from bonds, which would leave them with 60% stocks, 30% bonds, and 10% SDMF. Either option can make sense depending on the investor's goals. Now for some Q&A. When should investors expect SDMF to perform at its best or at its worst? We'll look at both absolute returns as well as relative returns versus stocks. The best period for absolute returns will be when there are strongly trending markets, either up or down. The worst period for returns will be when there are choppy markets with frequent reversals. The best period for relative returns versus stocks will be during extended equity bear markets, while the worst relative return will be during extended equity bull markets. How volatile is the DBI-CTA Managed Futures Index? Historically, somewhere between stocks and bonds. Since 2008, stocks have had about a 20 volatility, while bonds have had a volatility of about 4. The DBI index would have been in between with a volatility of about 10. What is the tax treatment of SDMF distributions? Distributions from interest on the cash collateral, T-bills and/or government money market funds, are taxed as ordinary income but are exempt from state and local taxes. Distributions from gains on the swaps are considered capital gains with the potential for them to be classified as long-term. Thank you for viewing this presentation. For more information about SDMF or any other Simplify ETF, please go to simplify.us/ETFs. We'd like to hear from you directly, so if you click the Contact Us link at the top of the page, you can leave us a message and we'll get back to you promptly.